It is a quiet Sunday evening, and you are sitting at your desk with a single lamp on. You are looking at a brokerage account that just crossed $10,000. Outside, the street is going dark. Somewhere a neighbor is wheeling a bin to the curb, and you are sitting very still because something just happened that does not announce itself. Scrolling slowly through a list of names, companies you now own small pieces of, feeling something you did not expect to feel. Not excitement exactly, something steadier than that. $10,000 is not a fortune, and you know it. It will not change your life this year. But it is the first amount large enough that the market can actually do something with it. The first time the numbers move on their own in a way you can see. You refresh the screen and watch the day's change tick by a few dollars, green. You understand, dimly, that those few dollars arrived without you doing anything at all. Here is what nobody tells you about this exact moment. The first 10,000 is not about the money. It is the moment you stop being a saver and quietly become an owner. Most people never make that crossing. They keep their money in a place where it sleeps. You just moved yours to a place where it works. And the next 6 levels are going to look nothing like this small, quiet beginning. Level 1. $10,000. This is the level where you begin. Picture the same person 3 months in, opening the app on a Monday after a brutal week in the market. Watching the balance sit lower than the money they put in. This is the test almost nobody talks about, and it arrives early. The first real lesson of a stock portfolio is not how to pick winners. It is how to keep owning something while it falls and not flinch. At $10,000, the temptation is enormous. The amounts are small enough that selling feels harmless. That jumping to the next exciting thing costs nothing. That checking the balance 5 times a day feels like diligence. It is not diligence. It is the exact behavior that guarantees you stay at this level forever. The people who climb out of level 1 are the ones who do something almost boring. They buy broad, they buy regularly, and they refuse to interrupt the process when it gets uncomfortable. They learn that the market does not reward intelligence nearly as much as it rewards the ability to sit still through fear. You start to understand that your portfolio is not a scoreboard to be checked. It is a seed that needs to be left in the ground. Picture that same person closing the app after the bad week, putting the phone face down on the desk, and deliberately not looking again until the weekend. It feels like nothing. It is, in fact, the most important investing skill they will ever build. The investor who panics out of a downturn at this level does not just lose a little money. They train their own nervous system to flee. That trained reflex follows them up every level that comes after, costing far more at 50,000, at a million, at every crash they will ever face. The single hardest thing at this level is doing nothing while everything in you screams to act. The person who masters that one skill at $10,000 has already won something most investors never will. This is the first thing nobody tells you about a stock portfolio. The earliest level is not about returns. It is about building the temperament to leave good things alone. At this level, you begin. Level 2. $50,000. This is the level where you commit. Somewhere in this range, the portfolio stops being a hobby and starts being a decision. Picture the same investor getting a windfall, a bonus, a tax refund, a bit of inheritance. Feeling the old pull to spend it on something they can touch. Instead, they route it into the account almost without thinking. Because by now the habit has hardened into identity. It is no longer something you do. It is something you are. At this level, the numbers get large enough to matter emotionally. A bad week can wipe out more than you earn in a month. The people who fail here let that sting drive the decisions, who pull money out to feel safe and miss the recovery. The people who commit do the opposite. They use the fear as a signal to add, not to flee. They understand that a portfolio is built far more by what you contribute and what you refuse to sell than by any clever trade. This is also the level where you stop trying to get rich quickly and start trying to get rich certainly. The exotic bets lose their appeal. The slow, relentless accumulation starts to feel powerful rather than boring. For the first time you can see the trajectory. You can run the simple math forward and watch where 50,000 becomes in 20 years. That projection, the first time you really sit with it, changes you. You stop asking how do I double this fast and start asking how do I never interrupt this. They stop seeing volatility as danger and start seeing it as the price of admission. They make peace with the fact that the road up is not smooth, that it never has been for anyone. The discomfort they feel is proof they are finally in the game that actually builds wealth. This is the second thing nobody tells you about a stock portfolio. The contributions and the discipline matter more than the picks, and almost nobody believes that until they live it. At this level, you commit. Level 3, $250,000. This is the level where you compound. Here the math finally turns and starts working harder than you do. At $250,000 invested, an ordinary market year can add more to your portfolio than you contribute from your salary. The first time you watch that happen, it rearranges something permanent in your head. You realize you have crossed a line. Your money is now a bigger earner than you are. The temptation at this level is to get clever, to look at that growing balance and think you have figured something out. Resist it. The people who win at this level are almost aggressively patient. They let the compounding do the loud work, and they refuse to interrupt it to feel smart. The greatest threat to $250,000 is not a market crash. It is an impatient owner who keeps yanking the plant out of the soil to inspect the roots. A market drop stops looking like a disaster and starts looking like a sale, a chance to buy more of the same machine at a lower price. Picture the same investor during the next real correction, watching the financial news call it a crisis, watching people around them sell in fear, and feeling something they would have found impossible a few years earlier. Calm. Even a flicker of something close to appetite, because they have done the math and they know that every share they buy in the red is a share working for them for the next 30 years. This single inversion, learning to want lower prices while you are still accumulating, is what truly separates this level from the ones below it. At $250,000, you stop measuring your progress against other people and start measuring it against time. The neighbor's new car, the coworkers bragging about a hot trade, the noise of everyone else's apparent wins, all of it goes quiet. Because you are no longer running their race. You are running a 40-year compounding curve that only rewards the people who refuse to get off it. This is the third thing nobody tells you about a stock portfolio. Your patience eventually becomes worth more than your income, and the down years become the ones that build you. At this level, you compound. Level 4, $1 million. This is the level where you protect. The seven-figure portfolio still carries a charge, and crossing it does something emotional even to people who watched it coming for years. But the real change is structural, not emotional. At $1 million invested, the game quietly shifts from growth to survival of the growth. You start caring about things you never thought about before, about how concentrated you are, about what one bad position could do, about taxes, about which accounts hold which assets, about the slow erosion you cannot see on any given day but that compounds against you over decades. This is the level where defense becomes as important as offense. The newly minted millionaire investor who fails keeps playing pure offense, treating $1 million like a bigger version of 10,000. The job is no longer only to grow the number. It is to make the number unkillable. You begin to think like an institution rather than an individual, asking what would it take to ruin me, and then engineering that out of existence. You diversify in ways that a younger, hungrier version of you would have called a waste of good returns. You keep the unglamorous reserve. You stop chasing the maximum and start protecting the inevitable. Picture the same investor sitting down to look at their portfolio as a whole for the first time and realizing how much of it rides on a handful of positions they fell in love with on the way up. The younger version would have called that conviction. The $1 million version calls it exposure. They trim, they spread, they build the boring ballast, and they feel not excitement, but a kind of quiet relief. The early investor wants the portfolio to make them feel something. The $1 million investor wants it to make them feel nothing. Because nothing means the structure is sound and the compounding is undisturbed. They have learned that boredom, at this level, is the sound of winning. This is the fourth thing nobody tells you about a stock portfolio. The first million is when you stop trying to win and start refusing to lose. At this level, you protect. Protect. Level 5, $5 million. This is the level where you allocate. Everything before this was about a single growing pile of stocks. Here the portfolio stops being a portfolio and starts being a system. At $5 million, you are no longer just an investor in the market. You become an allocator of capital across the market, deciding not which stock but which kind of asset, how much in public equities, how much set aside, how much deployed into things that are not stocks at all. The conversations in your head change. They stop being about individual companies and start being about structure, about the architecture of the whole machine. This is also the level where true work optional status becomes real, where the portfolio alone could fund a good life indefinitely without another contribution. The strange thing is that reaching it rarely makes people stop. They keep building because the goal was never to stop. It was to choose. At 5 million, the requests begin, the opportunities, the pitches, the people certain that a portfolio your size can absorb their idea without noticing. The people who hold this level learn to treat their capital as a position to be defended rather than a well for others to draw from. They build a system for saying no. They allocate deliberately on their own terms. They resist the urge to make a dramatic move just to feel the old thrill of the early years. Picture the same investor in a meeting now, across the table from someone pitching a once-in-a-lifetime opportunity, and feeling none of the urgency the pitch is engineered to create. They have seen enough cycles to know that the truly good opportunities do not require you to decide tonight. So they pass, calmly, on 9 ideas out of 10, and the discipline of those passes protects them more than any single yes ever could. You stop thinking about money as something to accumulate and start thinking about it as something to direct. Asking not how much do I have, but what is all of this actually for? This is the 5th thing nobody tells you about a stock portfolio. At this size, you stop picking investments and start designing a system, and the discipline to keep that system simple is rarer than any stock pick. At this level, you allocate. Level 6, $20 million. This is the level where you command. At $20 million, the portfolio is no longer something you manage personally. You begin to command the people and the structures that manage it for you. There is a team now, advisors, a tax strategist who thinks 3 years ahead, perhaps a private banker. The person from that quiet Sunday evening, refreshing a screen to watch a few dollars tick green, would not recognize this operation. Your capital is now large enough to have weight in the market, large enough to be courted, large enough that the terms offered to you are simply better. The danger at this level is invisible, and it is about attention. The thing most likely to erode you is no longer the market. It is your own loss of focus. There is something else nobody warns you about at this level. The people around you stop telling you the truth. The honest, abrasive feedback that sharpened you on the way up gets quieter and more careful the higher you climb. The investors who keep commanding go out of their way to keep 1 or 2 people who will still tell them they are wrong. At this scale, a single unchallenged bad assumption can cost more than most people earn in a lifetime. They command by subtraction. They say no to almost everything, let the structure run, and reserve themselves for the handful of decisions that genuinely move the number. Most people who built $20 million did it by being intensely hands-on. And now the very trait that got them here becomes the thing most likely to hold them back. The ones who cannot make that shift become the bottleneck in their own empire, exhausted and convinced they are indispensable. The ones who can step back and command lightly go further, because they have freed the one resource that actually scales at this level, their own judgment. This is the 6th thing nobody tells you about a stock portfolio. At the top, wealth is not managed by working more. It is commanded by deciding less, and deciding far better. At this level, you command. Command. Level 7, $100 million. This is the level where you endure. At 100 million, the portfolio is no longer about you at all. Capital at this scale stops being a personal balance and becomes a force in the market itself. Your positions are large enough to be part of the companies you own rather than a bystander to them. The question stops being how do I grow this and becomes how does this outlast me? You start thinking in trusts and entities and structures designed to carry the portfolio forward long after you are gone, into the hands of people not yet born. The number stops being a score and becomes a responsibility you did not entirely choose. The investors who reach this level and waste it are the ones who keep treating 9 figures as a personal trophy to be admired. The ones who matter understand that they are a steward of something larger than themselves. Their capital touches companies, employees, and futures far beyond their own life, and the only goal left worth having is to make it endure. There is a strange loneliness to this level that no one prepares you for. The decisions are enormous, and the people who can genuinely share the weight of them are very few. The investor who reaches 100 million and stays whole is usually the one who found meaning beyond the number long before they arrived, who decided what the capital was for while they were still climbing, so that when they finally got here the money had a purpose waiting for it. The ones who arrive with no answer to what is this for are the ones who become strange, restless, unable to enjoy what they built. And far below all of it, on a quiet Sunday evening, a person sits at a desk under a single lamp, watching a brokerage account tip past $10,000. They do not know yet that the exact temperament of that evening, the stillness, the refusal to flinch, the willingness to leave good things alone, is the identical temperament that, scaled across decades, ends right here. At the level where a portfolio becomes part of the architecture of the market itself. This is the seventh thing nobody tells you about a stock portfolio. At the highest level, the money is no longer truly yours. You are simply the one trusted to carry it forward. At this level, you endure the payoff. So let me give it all back to you in one breath, because the pattern only reveals itself when you see the whole ladder at once. At $10,000, you begin. At $50,000, you commit. At $250,000, you compound. At $1 million, you protect. At $5 million, you allocate. At $20 million, you command. And at $100 million, you endure. 7 levels, 7 verbs, and notice what they do. They start as things you do to your portfolio, and they end as things your portfolio does to the world. Here is the thing nobody on YouTube will tell you about a stock portfolio. The dollar amounts are not the levels. The dollar amounts are just the visible shadow of an internal change. From someone who reacts to the market, to someone who owns through it, to someone who allocates across it, to someone whose capital becomes part of the market itself. The balance on the screen is only ever a measure of which kind of investor you have become. Most people obsess over the picks and never build the temperament underneath, which is exactly why most people stall at the very first level. Remember the person at the desk under the single lamp, watching a balance tip past $10,000, feeling that quiet first sense of ownership with no one in the world to tell. They thought they had started something small. What they had actually done was cross the line that most people never cross. From saving money to owning the machine that builds it. The temperament that got them to that quiet evening is the identical temperament, only scaled, that carries an investor all the way to a portfolio the market itself leans on. Same person, same stillness, different altitude. If this video changed how you think about investing, hit subscribe. This channel is built for the version of you that is building quietly while everyone else is chasing the next hot tip. The first 10,000 is the hardest because it is where you learn to leave good things alone. Go build it.